Well, good morning, everyone, and welcome to Money Corp's first webinar of the year. January 2026 has certainly started off in a lively fashion. We've seen significant movement in the US dollar. Fresh highs were posted for sterling and the euro yesterday. And following the Federal Reserve's monetary policy meeting last night, there doesn't seem any reason why the market shouldn't continue to price for additional US dollar weakness. So we'll be diving into that today, and of course we'll cover the usual topics of growth, inflation, interest rates, monetary policy, the FX outlook, and geopolitics. We're also delighted to be able to offer you early access to our latest white paper. It's our 2026 Global Market Outlook. It offers a deep dive into what our thinking is around the dynamics shaping markets for the foreseeable future, not just markets, but also macroeconomics. There'll be time for questions at the end, so please make use of the Q&A box. And thank you everyone who's already submitted a question. We've been inundated, so really pleased that we're getting that level of engagement. So without further ado, I'm going to start the presentation. In terms of what we're looking at, we'll look at some of the forecasts for 2026, who's likely to be the stronger performers, who's likely to be the weaker performers. Look at inflation, which does appear to be moving in the right direction in most economies now, and therefore does that create the room for additional monetary loosening. Then we'll look at interest rates and what the outlook is for interest rates in 2026 and beyond. Before turning our attention to things like fiscal policy, we've had events recently, and we've got upcoming events that could shape macroeconomic dynamics over the course of coming months. Geopolitics, well, just when you thought things were calming down, it's all got a little bit more complicated once again. And finally, look at the FX outlook, and then look at some of our key themes for 2026. So both the IMF and the OECD have updated their forecasts for economic activity. And broadly speaking, it's similar to what we saw last year. So it's the US that appears to again be leading the way, growth stronger in the US in the IMF forecast, slightly weaker in the OECD's forecast, but then certainly more subdued growth in the likes of the euro area, in the UK, and also in countries like Japan, Canada, and Mexico. One of the things that I'd highlight with regard to the growth outlook is some of these numbers don't really add up when you look at the conditions, the domestic conditions at least, that economies are experiencing. And I'd highlight here China, where 2025 growth hit exactly the 5% target that the Chinese authorities had for it. And yet there was a distinct slowing in economic activity into the end of the year. And we've also seen some significant reductions in the levels of exports to major countries such as the United States. So there will be some significant headwinds as far as China is concerned going into 2026 and beyond, and not to mention that they've seen the fourth straight year where their population has declined. If you look at the US as well, it's really a question of winners and losers just in that economy. And there are suggestions that the US Treasury will be delivering a very sizable tax rebate to earners under the $100,000 a year threshold. And yet it's really those that are wealthier that are earning much more than that appear to be driving consumer expenditure activity. In the UK, it's more a case of, well, things could have been worse rather than that they're materially better. And there is definitely the argument for additional interest rate loosening just from the growth story alone, and also from some weakening in the UK labour market. But as I say, it does look as if other macroeconomic indicators are trending in the right direction to support additional action. And even for the likes of the euro area and Canada, where they were broadly saying that they were done, they've done all the monetary loosening that they need to, I'm not so sure that that is the case. Interesting, last night, for example, the Bank of Canada Governor Tiff Macklem said that he just didn't know whether the next move would be a interest rate reduction or an interest rate hike, and when that might actually happen as well. So lots of uncertainty created both from a political standpoint, but also from a macroeconomic one as well. So moving on to inflation and what we're seeing there, well, the trends are still moving in the right direction. Inflation falling in the UK from the highs that we saw in the summer. Inflation coming down in the US as well, albeit that we've had some interruption in the releases because of the US government shutdown. And there's the threat of another one looming at the end of this month. Not only that, I think that there's been some concern from central bankers about the pace of salary increases, but that's being created by shortages in supply in key areas, whereas in other areas, such as those in manufacturing or indeed at the lower end of the services sector, there appears to be an oversupply of labour for an undersupply of job vacancies. So it'll be interesting to see how the wage inflation figures play out over the course of 2026 and into 2027. And certainly, I think from a fiscal perspective, something that I'll mention a little bit later, public sector pay has to be more constrained than it has been over the course of recent years. So whilst we think that inflation is creating the room for cuts in the likes of the UK and the US, it's more difficult to predict if or when the European Central Bank or the Bank of Canada will be cutting interest rates. And for other central banks as well, the likes of the Norges Bank or the Riksbank, that's the Norwegian and Swedish central banks, there are arguments for on-hold policy for the time being, but that uncertainty around the global macro outlook, that uncertainty around tariffs, that uncertainty around the labour markets do still create risks around the need for further monetary loosening. So if we look at interest rates, well, I still think that we're going to see a further 50 to 75 basis points worth of interest rate cuts from the Federal Reserve. They're going to be leading the way and potentially leading other central banks as to what they do over the course of 2026. But the argument for additional rate cuts beyond that, something that Trump and his administration have been suggesting are necessary, I don't think really play out given recent macro trends. We've seen a stabilization or an apparent stabilization in labor markets, and the economy still running relatively healthily in terms of underlying growth. So more than 75 basis points of rate cuts looks unlikely, even if there is a change at the helm of the Federal Reserve coming, and we should be getting an announcement on who Trump's preferred candidate would be to take over from Jerome Powell, assuming that he steps aside. The Bank of England could also reduce interest rates by a further 50 to 75 basis points. I think, again, here, it's probably less rather than more at this juncture, mainly because of the additional fiscal spend that was announced in the November budget. Now, that may be binding the hands of the Bank of England, but more importantly as well, we still need to see further improvements in the inflation rate. It needs to come back much more towards target than it already has, but we may well see that when the January figures are delivered in February and further into the first quarter. But I don't expect to see a further monetary loosening from the Bank of England this side of the end of the first quarter. More likely that they'll cut in the early part of the second quarter. As for the Bank of Canada, I've already said they don't know when, if or where interest rates are going to be headed. However, I do think that there are still downside growth risks. There's still some uncertainty over the performance of the Canadian labour market, and inflation appears to be very well anchored around target. So there is room for one additional cut in 2026, and that would be my central thesis. European Central Bank, again, the same thing. But I thought it was interesting at Davos, the World Economic Forum, both Christine Lagarde and Joachim Nagel were warning more about the risks to economic activity than they were concerned by any upside risks to inflation. Now, that contrasted materially with some of the comments that we'd seen from the likes of Schnabel prior to Davos, who had indicated that the ECB were done, and actually the next move would probably be an interest rate increase, albeit a long way away. So it does appear that there is more uncertainty out there now, the same uncertainty that affects other economies like China and also Mexico, Japan. All of those economies are going to be facing something that's less predictable from a global trade environment and a global inflation environment than they were probably used to a couple of years ago. So interest rates, That unpredictability could create volatility in currency markets, something that I'll address a little bit later on. Fiscal policy, well, I mentioned about the US, all of the temporary measures, or the majority of the temporary measures that were agreed at the middle of November when the shutdown was lifted the last time, coming back to the forefront of market attention, because it looks highly unlikely that there's going to be agreement in the Senate or indeed on the floor of the House of Representatives in order to extend these temporary measures further. There are concerns about the overreach of some US agencies in cities across America at the moment, and that could create a real battleground and backdrop for another long and painful US government shutdown. I would suggest, though, the US already has a problem. In spite of the additional tariff revenue, the budget deficit in 2025 was around about 5.5%. And there's similar problems with sizable budget deficits in the UK, in France, in China, and also in Mexico. So these sorts of problems are ones that have to be addressed and don't appear to be being addressed by additional tax revenues. So is it that governments are going to have to be more restrictive in terms of levels of spending? Could this be a problem in terms of financial stability? This constant deluge of debt that's being pumped into the market at a time when inflation has been elevated potentially runs the risk of creating additional issues for government financing in the future and destabilizing financial markets more generally. Debt across the globe is climbing as a percentage of GDP, and I've mentioned previously that the rate at which US debt is expanding, it's due to increase or double in size rather over the next over the next 10 years or so, whereas the economy is only expected to double in size over the next 25 to 27 years. So there is a clear mismatch here, but there's an even bigger problem in China. If you look at China at the moment, their debt rates are rising at roughly around 8 to 9% per annum. And that, I think, will cause an issue if it's persistent. And that's the only way that they're likely to meet their GDP target. So it's kind of a catch-22. Two other things just to mention. 2025 ended with a lot of governments spending a lot more on defence. I think that will be a central theme of 2026 as well. So just watch out for that. That could lift some of the short-term growth indicators, but it could also put additional pressure on the public finances once again. Geopolitics, well, just when we thought things were calming down, we saw a US incursion into Venezuela. That Venezuela problem will potentially come back to haunt other issues around the likes of the Latin American region more generally. You've still got problems in Argentina over their economy, albeit they've faded somewhat. You've got the US rift with the European Union over Greenland and the US president's desire to acquire Greenland as a territory for national security and also for minerals. You've got the Middle East switching from the problems that we were seeing between Israel and Gaza, although those are still ongoing, and now to a widespread countrywide protest in Iran with the regime under pressure. And what could that mean for energy prices? We've seen oil prices rising to above $70 a barrel today, just as an example of those pressures in that particular region. And then you've still got the Russian and Ukraine war. So I think all of those things are going to continue to be pressures on the macroeconomic environment alongside the ones that I've already described. And then if we look at FX forecasts, well, at the moment, it's all about words. It's about what people have said that they might do rather than what they've actually done. So threats of potential intervention or rate checking by US and Japanese authorities prompted a very sizable move in the dollar, weakening in the dollar, not just against the Japanese yen, but against a whole host of other currencies. So that's why we've seen these moves against sterling, against the euro, against the Canadian dollar, and a whole host of other currencies. But the question that I would ask is, Has the macroeconomic environment really changed that much? And the answer is no, it hasn't. I mean, we keep getting a lot of chat, particularly from the US administration, and that has been difficult to interpret at times and potentially threatening of action. But the action hasn't followed through as yet. We haven't seen new tariffs levied on Europe because of Greenland. We haven't seen intervention actually happen. They haven't been buying the yen or other currencies and selling the US dollar. So will this rebalancing persist? In the short term, probably, but in the long term, as I've seen in the 1990s and in the 2000s, talk tends not to lead to a material rebalancing in portfolio or asset allocations. And safe havens continue to benefit, but that's predominantly because they're outside of the scope of the activities of authorities, and not even considering the likes of the Swiss franc, which is again appreciated against the likes of the US dollar and some other currencies. One other factor that I'd throw in here, does the Chinese renminbi really justify the moves that we've seen over the last sort of probably 3 to 4 months against the US dollar? I don't think it does. The fundamentals from the Chinese economy look ever weaker, more problematic. So I'm not sure that the Chinese renminbi can sustain its strength against the dollar. It's certainly not sustaining the growth that we're seeing against the. It's not justifying the falls that it's seen against the likes of sterling and the euro. So just watch out for that, and the Japanese yen as well. Verbal intervention never really worked in the past. Not sure why it would work this time around. Does the gold trend have further to run? Probably. I mean, it's almost spawned a life of its own. So our key themes for 2026: growth, the US outperforming once again, interest rates, further cuts from the US and the UK, but probably limited additional loosening from other central banks. Geopolitics, problems appeared to be materializing in a lot of other regions when we thought things were just about to calm down. Labour markets still problematic for the bulk of Western developed economies and even the likes of China and Japan as well. So watch out there, because there could be additional pain for growth coming from that. AI, will we ever see the boost to growth from the massive investment that we're seeing? Hasn't happened yet. China, I've already discussed just recently, and then commodities. Although we have seen this big increase in oil prices recently, around about sort of 10 to 12%, I'm not sure that it's sustainable given the move away that we're seeing from the West. So with that, I'm going to close out the formal part of the presentation and move to the Q&A session. And I did mention that we've already had pre-submitted questions. So the first one is, how do you see sterling dollar and sterling euro in 2026, and what can affect the currencies? We could probably do an entire webinar on these two. Sterling dollar for me, if we're just looking at this from the verbal intervention that we've seen recently, there's more legs in the short term for sterling dollar up towards 140, and sterling euro is held in well between sort of 114 and 3/4 and 115 and a half. But 2026, I think, is going to be a real challenge for sterling. If the UK authorities do have to reduce interest rates further and close the interest rate gap to the European Central Bank's level of official interest rates, then that will cause more headaches for sterling against the euro. So I see sterling euro moving lower over the course of 2026. Sterling dollar, as I say, short term, potentially higher. Longer term, I'm still not convinced that sterling has the legs to continue to push on much beyond 140. Now, we have got somebody asking about sterling New Zealand dollar. This is an interesting one, because we again would expect that a closing of interest rate differentials, which is likely between these two currencies, is likely to cause sterling some headaches. And certainly over the course of 2026, I've got sterling Australian dollar moving lower. Sterling New Zealand dollar is slightly different, however. And so you may see some divergence here. Sterling not making the same sort of losses against the New Zealand dollar that it does against the Australian dollar. But I certainly think it could go back down towards sort of 205, maybe even testing below 2 over the course of this year. But that is with sterling Australian dollar potentially moving down below 190. Next question is, do we still need to factor in a large risk premium against the dollar during 2026, given the seemingly ever-increasing number of uncertainty that Trump is creating? Well, I'm not going to blame Trump just for this. I think uncertainties are being created globally, even without his help. So what I would say is that risk premium against the US dollar, excuse me, is generally counter to the macroeconomic fundamentals. So for me, yes, he may be saying things with regard to tariffs. He may react to a situation and threaten new tariffs. He may also create conditions where global macro uncertainties rise, but there are other domestic factors in other economies that we need to take account of. We shouldn't be completely focused on what Trump is saying. We should be more focused on what the macroeconomic realities are. So I don't think we should be just factoring in a larger risk premium as far as the dollar is concerned. I think this could be a year where volatility picks up quite materially because of the increased threats and risks associated with the global macroeconomy. Next question is, what is your short-term forecast for sterling dollar? Well, as I mentioned, I think we see it up towards 140 in the very short term, the next sort of few weeks. But by the time we get to maybe a month away, back end of February, things may well have calmed down such that we see the move lower in sterling dollar once again. And if the fundamentals do come out in the way that has been described by the US president, he said that growth could be an annualized 5% in the fourth quarter. I think that that will cause a real headache to those that have been selling the US dollar recently. So just watch out. In the next week or two, we might well see some further dollar weakness. But as we get more fundamental data, that could be significantly challenged. A question here about dollar CAD as well. What's the forecast for dollar CAD over the next 6 months? I mean, this is an intriguing one because it looked as if the Canadian dollar looked as if it had no friends towards the back end of 2025. And yet, with what's happened in the early part of 2026, sure enough, everybody appears to be more sanguine about the performance of the Canadian dollar. As I said, I do think that the Canadian authorities might be getting themselves ready to cut interest rates, perhaps towards the back end of the second quarter or into the early part of the second half of the year. So that will create a problem as far as the Canadian dollar is concerned. Further upside for the Canadian dollar at the moment is governed by what's happening in the US, not the domestic issues out of Canada, albeit I will mention, and I did mention in our Daily Pulse this morning, that we've got Canadian fourth quarter GDP figures out tomorrow morning. Now, if they outperform, and that would be a surprise versus expectations, then that could propel the Canadian dollar to a little bit of additional short-term strength. I think, though, probably looking at it reaching a floor at around 131, 132, and then pushing back towards 138 and even 140. In the latter stages of the year. One other thing to throw into the mix, around about June, July time, the agreement between the US, Mexico and Canada is due for review. Now, normally this would be just a very sort of standard review process, and they'd agree to move forward with the agreement for another 6 years. Well, another 16 years actually, but given everything that we're seeing coming out of the US, I think they are going to want a more root and branch review of the whole agreement. Now, that could lead to the agreement being ripped up completely with the US looking to leave. So that could create additional volatility in the likes of dollar CAD and dollar Mexico over the course of coming months and into the second half of the year. Similar question, I think, this to, I think it was the third or fourth question, which is how do you view the stability of the US dollar for the next 3 years? I'm going to broaden that if I can be permitted to, and just say I think the stability of FX markets generally is going to be more questionable in the next 3 years versus what we enjoyed over the last sort of year or two. My view remains that markets are not necessarily looking at fundamentals, and they are instead looking at things that are more political and geopolitical in nature. The fundamentals that we're seeing at the moment would suggest that the dollar ought to have retained its strength that we were seeing into the end of November, rather than sell off quite as aggressively as we've seen from December onwards. So the next 3 years, that's a challenge for anybody to forecast. But all I would say is that the risks around the US dollar are more, as I say, political and geopolitical in nature, not macro at the moment. It's worthwhile heeding what the Federal Reserve Chair Jerome Powell said, which is that ultimately the labour market in the US appears to be stabilising. They appear to be producing solid, if not spectacular, growth, and inflation is heading back towards target. Those sorts of things would normally, without the noise that we get from the US administration, be more supportive of the US dollar than we've seen over the course of recent days. So my view is that stability will return to the US dollar in terms of strength will return, but the markets themselves might be more volatile, more affected by geopolitical and domestic political commentary. Final question. This is the $1 million question. If you were sitting in a CFO seat entering 2026, which single macro risk, rates, inflation, energy, or geopolitics would most concern you from an FX perspective? And what would you do differently now to manage that exposure? I go back to something that I said in the presentation around the Bank of Canada Governor, Tiff Macklem, where he said it's just less predictable. The whole environment is less predictable. And he was really talking there about trade, and he was talking about growth and inflation. So those, in my opinion, are the sort of three things that are more up in the air than they were previously. They, of course, then have effects on interest rates, but I think the market is doing a reasonable job pricing in the risks generally around interest rates for the major economies. For geopolitics, I don't think anybody can predict it. And if they're able to predict it, well, I'm not sure what they're doing listening to this webinar, because they should be trading for themselves and making an absolute fortune. So going back to it, trade, inflation, and growth. Those are the three things to focus on. But if I was to pick one, it's going to be inflation. Inflation is still the least predictable of all of these things. And that was proven in 2025, and I think will be proven again in 2026. So the forecast that you're seeing from central banks saying it's going to be a steady, linear move back to target as far as inflation is concerned. We may as well expect that those forecasts will be materially changed each and every quarter when those forecast updates come through. So if you're doing something different, think about historically what have been good levels to look at topping up hedging. Think about how you've been able to be more adaptive to a less certain environment. Those are the sorts of tools that are potentially going to be to your benefit if you're a CFO looking to hedge currency exposure, not just for 2026, but into the future years as well. It's about being able to react to the market environment, being able to take advantage when the currency markets appear to be moving in your favor, and to not leave yourself at risk that the markets might react in the other direction, might then sell off and find that you're chasing a market lower once again, which is something that we definitely saw post April the 2nd last year. We saw the markets react, big moves, and then start to slide thereafter, and it caught a lot of our clients out. It certainly led to, prior to the tariff announcement, a lot of activity, and then things slowed thereafter. Whereas now, hopefully, we've learnt our lesson. We don't have any further questions, and I hope that that's been of interest to you. Apologies for the slight tickle that I've got at the moment. What I would say is, first and foremost, thanks for dialing in today. I hope it's been useful and informative. Look out for the email about the white paper. That's going to be coming out almost directly after this. It's a download. We hope that you're going to find it interesting and useful. And if there are any questions that come from it, then do feel free to email me directly or your MoneyCorp contact. After this week and after the last sort of several sessions, given that things have been so much dominated by this increase in market volatility, we think that forward planning has never been more important for international businesses. So reach out to us. Let us help you strengthen your 2026 and beyond plans. And even if you decide to do nothing, being informed and taking an informed decision to do nothing is better than not being informed and taking the chance. But hopefully you've had an informative session today. Thanks for joining us. Have a great rest of your day. Remember to look out for the February webinar. We're going to probably be doing that slightly differently. So look out for the invite in your inbox and see how we're going to change up the format. But thanks very much for dialing in. Have a great day. Look forward to speaking to you again soon.